OptionVue Education Series. I'm Tom Nunemaker with our guest, Jim Graham from OptionVue. Today is the 1st of February, 2016. Before we get started, quick disclaimer, the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And again, this is for educational purposes only. So, welcome back, Jim. It's been a few months since we've had you here at Capital Discussions, and nice to have you back on board. And we're looking forward to what you have to say with OptionVue and little hidden gems inside.
All right, thanks, Tom. Yes, we try to keep a regular schedule with you as well as a few other people and do our own webinars occasionally, so I think you see us out a lot. I'm sharing my screen with OptionVue right now.
Yep, I can see it.
Hopefully everyone can see it. One place I'll just mention that we do post videos to is YouTube. An easy way to find them is just type in OptionVue. You'll see that there is OptionVue Systems. It's a channel that you can also subscribe to. It tells you when we're posting new videos. And you can see, for example, we just posted this one that James did today, Earnings Plays, the OptionVue Edge. And this one was one he did. We do have an earnings play module, which is an additional add-on. His focus is really, though, on the modeling in OptionVue. I think the last year and a half since we've incorporated the Johnson model, I think that's one of the biggest features of OptionVue. Of course, it doesn't help people who trade indexes, but I think I'll just start with that, because there's a lot of neat tools for it, and I'll choose something I know is coming up, which is Google. There's a Goog and there's a Google L. I usually follow the Class A shares. If you notice on a price chart of Google, up at the top, after the symbol, it shows a DVO. That means on average, this is in thousands, so on average this trades $31,664,000 in options per day. And one thing that I've noticed over the time, although it's pretty close actually, but it's a significant difference still. If you look at the Class C shares of Goog, they only trade $19,560,000 in options a day. So that's a pretty big difference. It seems like Google is a lot different, more liquid than Goog. And that's why I usually follow Google L, Googl. I was going to mention before I open the matrix, on the quotes display, you can see all the usual information, the last change, percentage change, high, low, open, close, or previous. There's this off extreme and time off extreme. I like to follow that at occasion, especially in a fast-moving market that's kind of roller coasting around up and down, because it tells you that, in this case, Google is down $2.19. Notice that's not for the day. It's up $13.75 for the day. But right now it's down $2.33, and that's from 25 minutes ago, so in Central Time, roughly about 12:40. Now that's telling you that it has been moving up, but the last 30 minutes it moved down. So, and you can kind of watch it. Now you can see it's actually kind of moving up again because it was up around 349 down. So you can kind of get a little better judge of how the stock's moving right now. You can see the volume, shares traded. The DVO, as we mentioned, 32K means 32 million. You can add news, and the news column is simply just a link. But if you click this link, the default is Yahoo, and I like Yahoo, so comes up here, alphabet, and takes you right to the page with all the information on Google, especially if you want to see what news there is today. So it automatically does that in your browser. I'm going to go through some preferences just to make sure people know what all these preferences mean and how you can customize your program, and you can customize where that goes. The last thing I want to show, especially, well, there's notes and there's also an earnings notes field if you want, but here is the last one, the earnings date, and here's where it tells me that it says 2/2 after, or 2/1 after the market close. So that means tonight, after the market closes, when they're releasing their earnings report. So now I'll go into the matrix. Now you can see I have some weeklies. I have the regular options. There's the February. If I go out a little more, here's March. You can always customize the format that you're in. I personally use something like this all the time. I like seeing the bid, ask, last, the actual prices being quoted. We have, and you can choose a different format, one called market price. Market price is a combination of bid, ask, and last depending on what preference you choose. It gives a single price of the option, which saves a lot of room in the matrix. But it is, for me, nice to be able to quickly switch over and see what the bid and ask actually is, what the actual last trade was. And then I like to also see things like the fair value, and is it over undervalued, maybe the delta, because I can quickly change this. If I want to do a trade, I'll just change this last one by right-clicking in any column, brings up this select parameter box, and you can change this. It remembers that change, and it'll continue to remember the change for as long as even tomorrow, unless you go back and click your little button to go back to that format. I have this set to format number 2. If you decide, I actually want to save this format, you can come up in the format, which gives you kind of a complicated way to choose what cell size, how many cells, 1 by 6, 2 by 3, what's in each one. Or if you're just making a simple change but you want to keep the same basic format of a 1 by 6, you can just click this little M and then the number 2, and now my number 2 format is set to this one with the trade in the last column. I'll go into define just to show you in this auto strike tab, which we have as the default that opens first, that here's where you choose what options you want. The weeklies if available, quarterlies if available, leaps if available. Not all stocks especially have all of those. Most don't have quarterlies. Quarterlies are only in things like SPX, RUT. I think SPY has them now. I'd have to look. Leaps. One thing, of course, is that if you're having too much problem with both with interactive brokers or thinkorswim, the more symbols that you're asking for, the longer it takes to fill in, the slower it is to update, because it's going to have to sit here and go through all these, and most of them are doing it somewhere between 75 to 100 a time, although I know that, like with interactive brokers, you can add additional symbols for additional costs, which makes it run faster. And so if you're going out and you're never even looking out here in the leaps, why have them defined? Same thing with the number of months and the number of weeklies. Define. If you don't need to see that many weeklies, you only trade very close to the money, you can maybe say, I only want to see 3 weeklies. And you'll see this last one, this weekly one, will go away. I can see February and March in the same thing. That's the thing. The other thing with the keeping a small format like this is it allows you to see everything all in one screen. So that's nice. So that's why I am always switching between formats. I get the impression most people don't use that very often. Now going to continue to go into talking about the earnings. What's so different about our earnings model? The first thing is you saw that we have the date that it's going to happen. We know when the earnings announcement is going to happen. If I click this first button under model, the volatility, and this horizontal skew, you can see that it's brought in that date. And now here it's telling me, here's the expected change once we pass this date, once the event happens. And it shows you what it looks like here. And here we are, this weekly one, which is currently at about, I should show the MIV just so you can see it. They're trading at about 76.2%. That's going to drop down to about 20%. This next one is going to drop to 20. So that makes a huge difference in the value. And just to give you an idea, I'll do a simple straddle, just buying an at the money of each. And here is, let me go to 3 lines. So here is today, and here is tomorrow. There's going to be a huge drop because I bought these options. When vol drops, so will the value of both the call input if the price doesn't change. So that's going to be a huge drop right there. You can see how the break-even is now. The break-even is 720 to 829 in a day. It's currently trading at about 772. So it's got to make a pretty decent-sized move, 50 points or so, just to make a profit with this trade. Now, one neat thing is even if I'm not looking at a straddle, you'll see down here there's these blue diamonds. No matter what trade I'm going to do, maybe I just buy a call, those blue diamonds are still there. These blue diamonds are showing what the straddle is priced at. It's showing what the market makers basically are expecting, and the market as a whole, expecting Google to move, what they're pricing it at. So that's how they're making their money. As long as it stays within those 2 diamonds, they're doing okay. They're not doing as well if it moves outside those 2 diamonds. Now, how does that compare to what probably might happen is shown by these red and green triangles here. It calculates this based on the last 8 earnings plays. And it's saying the last 8 earnings plays, if it went down, here's the average amount that it went down. And then it's saying if it went up, here's the average amount it went up. You can see those triangles are well within that range that they're pricing the straddle at. And I can see here in the matrix, it will show you right down here in the bottom left corner, the expected event is modeled at T+1. So you can see that's why it's such a wide gap here. If I was to go and buy one, let's see, here's one that already announced their earnings, just standard volatility. If I go look at the model volatility, you'll see it's already here. It's not projecting any change in volatility. There's no event here. It's just a nice, smooth, horizontal skew. And when I analyze, and I'll go to 5 lines just so you can see, it's got a much more regular interval between each line as you're moving up, as opposed to the Google one. So let me go back to putting the straddle in here, and I'm going to go look at the price chart. In the price chart, there's also some special things for earnings, such as this, clicking this E here turns on these little triangles. It's showing when the earnings announcements were for Google. So you can see there's one coming up tomorrow. Here was the last one, quite a big jump. Here was the one before that, quite a big jump. Before that, a little bit of a jump, but not very dramatic. Not dramatic like the last two. They're actually, I think, looking at these last two, and that's why they're pricing the straddle so wide. One nice thing is if you have a trade in here, you can then also click on this to show profit zone, and it's showing me here's where I'm not profitable in the red. The green is where I'm profitable. So you can see being, let me just draw a line, like right here, how far I have to move up or down. The little blue lines is the break-even points for that trade to make any money. So now that I'm in the price charts, I thought I'd show some of the things in the price chart. There's a lot of different things you can superimpose, like the volatility. Now, you see that once I have this volatility line, it shows a blue line for the implied volatility, a red line for the actual or statistical volatility. Oh. I don't want to draw a line. If you click, as long as you don't have this line drawing where you can draw trend lines, this lets you just draw a line anywhere you want. Hitting escape will get rid of the line. Keep hitting escape again, you'll notice the other line disappeared. But you also have to turn it off. Then when you click in, you'll get a wand. The wand causes a readout at any date, and it shows you the open, high, low, close, volume. And if you have the volatility lines superimposed, it shows you that. So go all the way to today, and it's showing the open, high, low, close. Showing SV is 37, average IV is 36.9, and you'll see next to them there's a 98 in parentheses and a 93 in parentheses. That's also shown up in this once you're superimposing the volatility chart. The 98 and 93 means it's at the SV is at the 98th percentile, meaning 98% of the time it's been lower than it currently is. And IV, 93% of the time it's been lower, so it's been moving a lot and more than usual. Now down here in the bottom, there's little buttons that also become available when you're doing the superimposed volatility. The V button, click that, and you get a little table. It shows the average volatilities: 3, 6, 10 weeks, year and a half, 3 years, 4.5, 6 years. So you can see that it's been considerably lower in the past. So Google's been moving around a lot. The actual stock's been moving around a lot. And the IV is reflecting that, although maybe now even just a little more than it's actually thinking. Maybe it'll even be more volatile, or at least that's what people are thinking possible. And then there's the M. The M kind of splits up that implied volatility line. Now you can see, let me just get rid of this V, what each of these are, the 30, 60, 90, 1 year, and 2 year. And as you move along, you can actually see how the volatility skew changed. Let's go back and start looking at, right as you're going over in earnings, you'll see how there's this uptick in implied volatility in the shorter term maturities, expirations. And then as soon as they announce earnings, you can see how that drops down. It's actually lower in the short term volatilities than in the farther months. Similar thing will happen here and here. See, actually, they seem to push this up much more than usual than the last two I just showed you. And it turns out to be right because it moved a lot. And how about this one? Same thing, pretty high, but then look how far it dropped right away. Now that's the 30-day. Of course, the weeklies are out in here, and they tend to be even higher, as we saw up to like 70. So that's this little M button. You can turn them on and off. And if you're in the multi-chart alone, those buttons are available too. Let's see. Let me just bring this down a little bit just so I can see if I can see my chat here, just to see if I'm missing anything.
Yeah, there's one on Ray asked, can you get less than 30 days with the M button?
No, that M button, that's what we store, is the 30, 60, 90, 1 year, 2 year. We do not store any of those short-term low volatilities, especially because a lot of the stocks don't even have it.
And Norman made a comment, when you guys decide to select colors for diamonds or lines, do you consider that 10% or more of males are red/green colorblind?
We do in OptionVue try very hard to not convey any information solely by color. I think that earnings diamonds are one of the few things that's the only thing that are just solely by color. I can bring that up and maybe see if there's a way that we could get a pop-up where you can actually read it there. Something like that. We usually do something like that, that if you cannot see the color, there's still another way to see the information.
Maybe the shape or size of the diamond or something.
You'll have to give that some thought. I hadn't even thought of that one. I believe that is one of the only places in the program where the information is solely being, I guess in some ways it's really not, because generally the downside is going to be, for the most part, lower than the current price, and the upside is going to be higher than the current price. And the straddle doesn't really matter what color it is. You're seeing where it's priced to go both sides. So it's really only the red and green earnings.
Chuck commented or had a question, why do the auto strike settings change from date to date in BackTrader?
I'm not sure what that means. The auto strike settings should stay the same. If you go into this define auto strike, it should be the same. It should not change over time. Let me go back here to the price chart. There are more things here in the price chart. Some of them are things like there's a split, you can do the split adjustment, edit the data. If you see bad bars and things in here, many times it may be because we got some bad data across, but we go through and try to clean it up. I'll try to find one, because we've been having some problems with some bad highs coming in natural gas. And you can see those in here. Some bad highs come in, and they are not real. One way you can do it is just click anywhere before it. I could click here, 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 anywhere, and then click this calendar. It says refresh historical data, since it's going to bring in the date of wherever you clicked. Or you could just type a date in here. And you hit OK. See, looks like he hasn't fixed those yet. But let's see if I can find something else maybe is working on. Sometimes in the softs and the futures we've had some problems too, like cocoa. But that's how you refresh a chart. If you see some bad data, you can always go refresh a chart and see if that makes it look a little better. Let me go.
A couple more questions. David asked, why can't OptionVue calculate MIV on Friday of a weekly expiration? There's a lot of volatility still there.
Does not calculate volatility if there is, I believe, less than 3 days. But it does measure volatility, and the actual calculation for volatility, if you get down to very small numbers, like I think we use less than 3 ticks, so it's like 15 cents on most stock options. If it's less than 15 cents, if it's got less than 3 days of life left, we don't calculate and show an MIV. However, we do show a projected volatility. And that's what you can look at to see what the current volatility skew is. You can still see it, and you can see there can be a slight difference between the MIV and the projected volatility, because projected volatility is what the best fit volatility skew curve is. But as you can see, especially on something like Google, there's going to be virtually no difference, especially around the money, like a point or two, a couple of points. So if you're interested in seeing what the vol is of that option at that time, I suggest looking at projected volatility.
Okay, Skip asked a question. He said he often needs to recenter the matrix to show his positions. Is there a way to freeze what strikes are showing?
I'm not sure what he means, like if it moves off, and then he reopens it. I know that even if I get both of these totally off and close it, you can see they're still off. But we do have these arrows over here which let you move to where your positions are. And if I had another position down here and then another one way down here, you can see that it'll come up if I click this thing, and it'll show me these two, but then there's still a down arrow available, and it'll show me this farthest one and this one. But if I deleted this one and went up, now it's showing both of them. I don't have any other positions that are not being hidden here. If I had a position out farther, out here and out here, it's going to show me with this arrow, and I can go back and forth like that.
Yeah, he says the arrow, he constantly has to hit them. So I guess if he goes to like an analyze chart and then comes back to the matrix, it's moved around a bit.
I'm not seeing it. No, I mean that's what we have to find your positions real easily. Is that I'm not seeing that, so I'm not sure what to say other than that. Let's see. I can go back to my price chart here. We do let you set a target in the price chart, which lets you can see the expiration days there, the most recent ones coming up. So if you were thinking somewhere around this expiration day or even just before, you can move this, you can drag the box where you think Google is going to be at that time. The width of the box is time. The height of the box is price range. It shows right up here. Price range is that. The date range is that. You can drag it, and one thing you can use this for is in Trade Finder. When I put Google in Trade Finder, you'll see that it brings that target in automatically. Also, now that well, I have a position, but it's not far enough out, I don't believe, because it's going to expire before my target. But I'll put one farther out, analyze, you'll see there's a shaded area in the graphic analysis. That's showing you where your target is. So when you're looking at how profitable will this trade be, rather than just look at it all overall, you could look at trying to maximize your profitability in here just as the Trade Finder does. Trade Finder does not try to get you the best trade possible over all ranges. It does it over your target. And then to turn off the target, you simply turn it off. Showed you the profit zone. There's candlesticks, if you like to see candlesticks. Looks like there's a bad high there. That's one way to see something like that. If I actually went on that date, look at the high, low, close. Oh, I see the open is $58.36, $5,836. I'll have to get them to fix that. Which I should mention, I'm not a tech person, so that's why I don't work too much day to day with software and helping people or anything. I'm actually a COO here, so most of the time I just do all business stuff all day. But I've been working here a long time. I started out as a product rep and worked with Len for many years as a product manager developing the software, so I know it very well. 716. And of course, anytime you see something like this, you can fix it yourself. And I could go look what the actual open is. But I'll just say something reasonable would be like 600. So I could hit this edit button. I can see this bad one. I'll say 680. And okay, you'll see now that red bar is not that huge. But I'll have them actually go look up the correct one to put in there and get it fixed. Then I'm going to take off the volatility just so we just see the price charts. And I'll even take off the earnings and just back to a standard bar chart. It's going to look at some of these indicators. You can see I just click it, turns on. It's going to turn on whatever your current settings are. I have it set for a moving average of 1550 and 200. So you can see Google's well above its 200-day moving average. A lot of people say never buy a stock when it's below its 200-day moving average. And 50-day, it just moved past it yesterday. And, of course, the 15-day, it's quite lower. But let's do this. And down here, I have it actually set to show the VX diff. This is an indicator for whether it should be long or short the VXX. It's saying right now you should be long VXX. It's not related to Google. But the next button is where you set them. Here's where I have my moving averages. You could change it to be 20. And just adjust it slightly, and so that's what you could do, 1, 2, or 3. You don't have to. You could just show the 1. You could do simple or exponential averages. There's Bollinger Bands, acceleration bands, fair value, but that's for the VXX and XIV only. There's the auto trend line. It just automatically draws a trend line. As I mentioned, you can draw your own trend lines. You can expand them somewhat out into the future. And then in this thing, there is also a little checkbox. If you have a lot of trend lines on there, you just want to get rid of them all. Just hit clear all hand draw trend lines and hit OK. Now notice I do have it set to do the auto trend line right now. I'll switch it back to moving average. It also gives you a setting for how your candlesticks are. I have mine filled in, but you can do hollow. Now when you turn on your candlesticks, yeah, they still look pretty I guess they're hollow, but I'd have to expand it a little more. Here's where you can drill in or out. And actually, one of the things I really wanted to get into are these lower chart ones. So I'll turn off this top end. You can just grab this line and move it if you want to expand this out. That reminds me of what Tom had mentioned earlier. You can do the same thing in the matrix. I'll show that later between the column puts. So the window is changeable. It makes it easier to see down here. And there are things like pretty standard technical analysis things. But one of them is this put-call volume ratio. This is actually a pretty big project that we do and have been doing. We store all that put-call volume data every single day. We store the put volume, number of contracts traded, call volume, the put dollar volume traded, call dollar volume traded, call open interest, and put open interest. And by separating in between calls and puts, it gives us a bunch of different available things. I can just show the put, say dollar volume, call dollar volume, or put plus call dollar volume. And I'll just say you could do a running average of it up to 40 days, but I'm just doing a day-by-day thing, no averaging. And hit OK. So now I can see what have they been trading. Especially recently, this blue line's really high. This is the put dollar volume. The red line is the call dollar volume. And down here, now again with the wand, I can see what the actual number is. This particular day, there was a huge spike in put dollar volume. They traded 50,868,000 in puts versus only 20 million. So put call volume ratio, that's a common indicator people use of sentiment. Let's take a look at what it looks like in using actual contract volume. Oh, I'm sorry, I didn't have them the same. You want your calls and puts to both be dollar volume. Wow, I think that's a bad. Can't edit that, so I'm afraid. You can only edit the price chart. We can see this. Let's go back. Where here was 20 million. Oh, here is the biggest spike in 39 million versus 10 million. But then you can also just look at simple contract volume, the number of contracts traded for both. You can see it has been more puts than calls traded. And then, of course, the last one is open interest. How many put contracts are open versus how many call contracts are open. You'll see that there's a sawtooth pattern to it, and that has to do with expirations. All of a sudden, there's a whole bunch that expire and drop off. Then more come on. See, right now there's 86,294,000 contracts open and puts and 92,303,000 calls. A few more calls and puts. But let me go into the actual put-call ratio. That's what a lot of people look at. I'll do it using dollar volume. I'll just show one of them for right now. The dollar volume of the put-call ratio. It jumps around a lot. And most people say you're looking at one all the way across. When its put-call ratio is higher than 1, people are buying more puts than calls. When it's lower than 1, they're buying more calls than puts. So that means, of course, when it's greater than 1, people think the market's going to fall. The interesting thing, of course, about the put-call ratio is that it's a contrarian indicator, meaning the market tends to be wrong. When the put-call ratio moves above 1, it's a bullish indicator. Everyone's against the market, so jump in, and vice versa. You can see right now it's at 0.55, so pretty solidly bullish. But it hasn't been that long. Let's see, here's the last time it went above 1 was back in January 11th. That's not a surprise because that first week was not the greatest week for a lot of stocks. You can see it's starting out here on about 1231. Put call ratio quickly jumped a couple times, pretty high. Now let's look at put call ratio using open interest, which tends not to change as much. So you can see actually there's this little spike here, but for the most part it's been below 1. Back here in about the December, here's where it first dropped below 1 was January 20th. So for quite a while, you can see from January 20th back to 1028. It's been higher than 1 for the put-call open interest ratio. I just always think that that's something a lot of people would like, and it seems like very few people know that we have it. I think I've pretty much gone through the price charts here. Just check the chat again.
There was another question
the
from
FX
Ralph.
performance has not been very good lately. I see that one. It has not done well the past 6 months for sure, I know. Seemed like with the VXX now long, it has not been moving up that much. I'm sorry, that was pretty long ago. I'm right to the beginning.
Yeah, there was a question from Ralph about at the end about the March 4 options and SPX are not listed when he opens the matrix. He has to manually add it every time he opens the matrix. Is there a way to keep it in the matrix?
Well, let me open my SPX. I'll go to that smaller format so I can see more months at once. And you'll see, assuming it's talking about this one, the weekly one with 33 days. See, there's 1, 2, 3, and this is the 4th weekly. Then in between, there's a February. There's also a monthly and a quarterly here. So, of course, has the most. When you have this include weeklies, it also tells you how many weeklies do you want. I believe at times the SPX can have up to 6. So I'm guessing you have it set to something like 3. So when you hit OK, you'll see that weekly one is missing now and is gone. But if I go and I change that to say 4, or in this case I'll just say 6. Let's see how many show up. Here's this weekly one. You'll see there is also another weekly 2 here with 40 days. And here's the weekly 4 with 53 days. So there's actually 6 available on the SPX. That's the most of any asset. Hopefully that's the problem that you're hitting, because otherwise you'd have to go in and manually do it. But then the next time you open the matrix, it's going to say, oh, you only want 3 of these, so I'm throwing this one away. All right. Let's see, I'm pretty much really close to time, but I wanted to quickly at least go through and just go through the file preference areas under here. And the file preferences, I'm sorry.
We have a few more minutes. Take your time.
Okay, file preferences. There's a number of things in here. Here's the thing. First thing is about batch updates. And it's just if you're doing a batch update. Like, for example, if I run Trade Finder on a group of things, I want to update that group of files right before I do it, just to make sure I have the latest data in them. So, for example, I have let's find a smaller group. Here's one with just a few ETFs in it. So I can go up to NetView, Update Asset Files. I can click this little G button, brings in only anything in this group I've selected and I'm clicked in, and hit go. It's going to run through those 5 things and update them. So now all the options, everything has the latest data. Now I can come into Trade Finder and put this group of them in there. I can say if on average these move up between 5, I'm gonna do it as this little button here to the left of the group, because that's what most people won't see. It's actually more useful because each of these are going to have a different price. This lets you set them all targets as, and I'm going to say from a 5 to 10% increase by about June 18th. No, I'll go shorter. So you see that putting in X2 gives me the second expiration out of the monthlies. So like February, then March. So X2 gives me March expiration date in there. Hit OK. You'll see it saying updating targets. So now you can click in this list and actually see the price range. This is a 5 to 10% price range on DVY. 5 to 10% has been set on all of these. Now I could easily choose, say, a strategy, like I'll just choose a couple because I don't want it to take long. Goals, I'll put $1,000. Say go. Then we'll run through each of these assets. You can see it working up here. EEM, it's working on vertical debit spreads, EFA. Now, of course, this always works in a group better if you're looking at a group of stocks that have similar characteristics. You know, if you're putting in a few tech stocks, it's probably okay, like Amazon. How about the FANG stocks or something? Facebook, Amazon, Netflix, Google. Probably would not work as well if you're putting in a group something like Procter & Gamble, JP Morgan, Microsoft, and ExxonMobil. They're groups that have nothing in common. They're probably not going to move that closely together. And then it just tells me, oh, here's the best expected return is on the DVY. Buy those calls if they move up 5 to 10. Colors, lets you adjust colors here. Enablement just gives you information. There's nothing to do there. Folders, you can set this up to run with your folders in like a Google Drive, OneDrive, Dropbox, so that you could actually have it on a couple computers and always point all your files right to that file on Google Drive. That way you're sharing files, everything's always up to date. But of course, also if you just have it on one computer, it's still saving them offline on the cloud, which is a lot safer. Can adjust the fonts and things. But in the graphic analysis, there's a couple things, like if you want T+N or to display dates. When I'm looking at Google and I analyzed, you'll see that in this little legend, it shows me the actual date of each line. You could have instead saying T+0, T+30, T+10. And also the graphic analysis dot, which is they call it the gram dot because I came up with it. And whether you want to start with the T+0, if you have that checked, that's the line that's highlighted. Otherwise, it will be the expiration line. I'm going to turn off the dot. You'll see when I analyze, there is no dot here anywhere. Now I'll turn it back on. And I'll expand this, and you'll see here's the dot right there. And if you hover over it, it says it's 0 because I'm just looking at a trade. It's at the current price. The reason we did this is everything in this graph is theoretical. All these theoretical prices at every possible future date and price. The only thing in this whole graph that's based on actual market prices is this one dot. And what I'm looking for is a differential between the T+0 line, the fair value right now, and that. I have had occasions where the dot's way down here, but it's saying I should be up here. Most of the times, if I let it sit for half a day, or sometimes it takes a whole day, usually it eventually comes back up to there, saying it's not the best time to close the trade usually. Then other times, I've actually had it where this dot was way below, way above the actual line, saying, the price they're quoting them, they're not even worth that much. I've had it like a vertical spread where I still had 2 weeks to go, and say it was $1 is the maximum I could get for the spread, and it's already trading at like 90 or 95 cents. So I just went ahead and closed it quick. I'm like, oh, why wait the 2 weeks for that last 5 or 10 cents? And a couple of times when I've done that, literally within like a minute or two, boom, the prices snap right back to where they should have been. So I got that profit like a couple weeks early. That's the real use of that. People are always wondering, why doesn't it exactly match the line? What a lot of traders are looking for is they want a case when it's not matching the line. There's actual name for that in trading too. It's called edge. It's either a positive or negative edge. We actually have that in the account status. I believe it's only in the professional version. It's called edge. So this one has a positive edge of $370 right now. Let's see, file preferences. And then in the, if you have the Pro version, there is a choice between regular or market maker style detail analysis. The detailed analysis is nice because if you're wondering how we get some of these numbers, like for tomorrow in Google, then I'll say, what at about 7:05? So this is the highlighted line. All these numbers refer to this highlighted line. You'll see if I switch lines, the numbers all change. But now where this wand is at 7:05, I just typed it in there. You can also drag it around. Oh, drag it here. And you'll see that wherever you are, those little display comes up. Now when I'm at 7:05, how does it come up with what it thinks this will be worth tomorrow at 7:05? You hit the details button down here, and it shows you each leg showing. Here's where it currently is at. It's showing what the projected volatility will be at closing. So you see 22 and 21. It's projected that 55% drop in volatility because of earnings tonight. Here's the fair value it's calculating. The app price. Now, what if you don't want to? What if you think, oh, I just want to see it without volatility dropping? You can actually do that in preferences in this matrix. Let's see, models. Under models. Regarding the horizontal skew, automatically model the volatility ramp up and drop associated with next earnings announcement. In the week or two before an earnings announcement, each day volatility is rising slowly until you get right up to earnings, and then after earnings announced, it drops. But if you uncheck this, how up here there's a button where you can clear stuff like the trades. I'm going to go back to that original straddle I had and hit Analyze. And you'll see I don't have that big drop tomorrow. It's just going to stay around here. That's what it's thinking. It's really not even sure. It doesn't even really make that much sense. You'll see some of the lines move from 5. You can click here to select the lines to 11, 15, and then expiration, as opposed to having it on, which is the default. You can see that big drop it's projecting. What else we got under file preference? So I was going to mention, let's see, the matrix. Just in these columns, I have the March. It shows the number of days, 47 days till expiration, what the actual expiration day is, or at least a Saturday after the expiration day. And you can choose instead to show just the number of days remaining, expiration date, or both. I like both. I wanted to also show news. Here's where the default is going to Yahoo Finance. You can actually see how it's got the whole URL, and then S equals symbol. And that symbol is when it puts in like Google, and it goes directly to the page for Google at Yahoo Finance. If you like something else, like say MarketWatch, and you put in a symbol, looking for a symbol, how about, well, might as well stick with Google. You'll see up here it says MarketWatch.com investing stock /Google. So you just need to copy this in and paste it in there in your program, and just leave this last part from the question, like this Q question mark S symbol. That's where it's going to put it in.
Yeah, I put the one I use for Zach's News in the chat.
Portfolio managers, anything else? I think those are some of the big ones. I mentioned the multi-chart too. I'd mentioned the percentiles. Percentiles, if you just leave this blank, it's going to use all available history. I believe that's a default. A lot of people like to just look at what the percentile is compared to the past year or 2 years. I use 1 year. So you can see if I go up to the multi-chart, and as I mentioned, it's at 96 and 92. That's compared to the past year. Now go into File Preferences. I'll just blank it out. Say use all available history. See, now it's only at 83 and 78. So it's using all available history. So that's another setting I don't think people look at a lot. I see now I'm really right at about an hour, so I'd say that's pretty good. And hopefully I'll go back up here and I'll look at the chat. But hopefully some of these things are things that maybe you didn't know about. I did promise Tom, though, that I would show in the matrix that here you can take this bar and move it. So now more of them are puts. You can, in fact, take it basically all the way out. Say, make them all puts. I have this legend on. If I turn this legend off, you'll see I actually have one call in there, or vice versa. I should have had a more bigger position set. But here I'll just put in a whole bunch of different trades in different months, different strikes and things, calls and puts. When you see down here, here's the summary, here's the cash flow, your delta, gamma, theta, vega. If it was a position, it'd show my current value and gain loss. If it was existing position. Now, I can look at, say, just the February's by clicking on just February and hitting Analyze. You'll see it gives me just the February options. If I hold down Control and add this one, you'll see it'll add those two. They don't have to be next to each other. If I hold down Control and then go over and hit this one, I'm still holding Control. Now let go, Analyze. It'll show me just those two. So you could look at various expirations. Over here on the options, here's everything together. If I click on this options name here, notice it switches to calls. Now it's only showing the calls section. If I hit puts and Analyze, now it's showing only the puts. If I click it one more time, it goes back to all of them. Now, if I were to convert them into a here, you can use recon codes to say these are different trades by using letters. And I have A through E. Now, up here, because I'm using these recon letters, this becomes available. Existing position included. All. If I click on it, you'll see I have my A, B, C, D, E trade. Let's say I just show the A and D trade, hit apply. Now I just have those two trades that are being done. So you can do any combination of trades that you have shown in here. All right, since now I went over, but I did want to get to that. Is there anything else in the chat there, Tom?
That's it. Wayne asked, what strategy should we use for Google earnings today?
Well, it says that should buy a straddle or strangle about an hour prior to the close on today.
That's about now.
Yep, right about now. That's been successful 3 of the last 7 times. The quality 1 ranking of 41 means that on average the trade made 41%. That means if you did all 7 trades, you would average a gain of 41%. So say you did $1,000 per trade, $7,000 worth of trades over 7 quarters. You would have made about $2,800. What that means, of course, is that the ones that were successful far outweighed the losses. If you're buying a straddle or strangle, chances are you only lose like about half at most. But you can make 200-300% on the upside when you're correct. Now, buying a straddle or strangle means also it's up for whatever one you want to buy. But, of course, you're being long both options. Oh, this is the regular Goog, or Class C Goog. I'll go back to A. And you can see my legend, what the MIV is, 43, 41, 33. That drop in volatility is not going to be helping those front 2 months in a straddle. So you might want to go a little farther out where it won't be hurt by that big drop in volatility as much. It'll go down a little bit, but not. Oh, I have so many things in here. Let me clear them all out because I had all my existing positions. Oh, I still have them in there. Oh, I just switch accounts. So I put them in that account. So now where's the break even on this one tomorrow is 698 and 838. That's not that good. Well, you can look around and see what you think. But I will mention, on the earnings, there's several different kinds, the E primes, the E over naked, or E over as calendars. depending if you want to sell naked straddles or you want to do a calendar instead. And then e-pairs, echoes, and runners. They're all very different types of strategies. E-primes, you're buying straddles and strangles. E-overs, you're selling naked strangles. E-over is calendars, you're buying a calendar, horizontal spread. E-pairs is things that, like Google and Microsoft. So say Google's or Microsoft's announcing, take a position in Google. When Microsoft announces, Google will also move. E-pairs is similar that they tend to move the same way. Once the earnings has gone off, and say it's up at least 3%, then you would take a directional position for the other stock to go up as well the rest of that day. And runners is ones that once they move tend to jump up or down after the announcement. The rest of the day they can tend to move quite a bit and continue in that direction. So you just buy a call or put and just follow along. Actually, there's different quality rankings you can do, but I just use our default quality rankings. Up here in the E, if you click here, if you have the earnings module, plays module, you'll get this. These are just different quality rankings, and you just hit go and it'll automatically update your all your different categories, tell you what the available trades are. You can also, under E, go to this earnings search. And the earnings search will tell you, you can say, I just want to see all stocks next 3 business days. I want them to be optionable stocks. That highlights these. The other ones don't have options. Exclude stocks less than $5, less than a DVO of 50. See, there's 108 optionable stocks in the next 3 days that meet that. That's going to announce earnings. And it will tell you the date. You can just simply right-click and say, add it to my quotes display, earnings search results, and it'll add all those stocks there that have earnings coming up in the next 3 days. Start looking through them. We also have a little calendar that just tells you what trades are coming up and what's going on. But I do just put on a trade, just an average. I use an average of $5,000 per trade, just to make sure I have enough to do things like naked straddles and stuff, but just to make every trade roughly the same amount. And you'll see in this account earnings plays for this quarter, started January 12th. It's up about 30%. So I have there's 5 different categories. I put 10,000 each, which is usually enough to cover all the trades, 50,000. And see, it is now worth 65.5, so up 15.5. You can actually look at this performance analysis, and I'll just include all of these. Here's all the different strategies. You'll see this time it says 16,727. There was 35 trades in the last 20 days. 21 were winners, 14 were losers. Average winner was $1,300. Average loser $763. The largest winner was $8,300. The biggest loser was $2,840. Remember, these are $5,000 trades, so again, that's roughly 50%. It's usually about your worst loss. And you can see actually every category except the E-over calendars has been profitable, but the E-overs, even the naked, not very profitable. E-primes doing okay, echoes doing okay. E-pairs has been the most profitable. Made $9,000 there so far, and runners at $4,700. So I'd like to just track it and see how good it's doing. All right, now I've gone way over. So any other questions here?
Ray said thank you for your time and sharing today, Jim. So I echo that opinion and really appreciate you taking the time to be with us today.
Oh, sure. And I've been trying to stay on the boards too occasionally. make sure I answer questions there too.
Appreciate it. Well, like you said, we're past our hour that we usually like to stop at, so it's a good time to stop, and I forget who's coming on next in a few weeks, but we look forward to the next installment of the OptionVue Education Series.
All right, thanks, Tom.
Thanks, everyone, and we'll see you later.
Bye-bye.